Have you ever opened the Robinhood or Fidelity app in the middle of the night, your heart racing as you watched your portfolio bleeding red? One day you're up $2,000, the next day it's gone. And you start asking yourself, is the stock market just one big casino? Can an ordinary person like me really beat Wall Street? From the dot-com bubble to the 2008 financial crisis to the recent GameStop and Dogecoin frenzy, U.S. stock market history is full of stories where millions thought they were on the verge of striking it rich, only to be left with nothing but debt and disappointment. The book, A Random Walk Down Wall Street by Burton Malkiel, offers a blunt answer. You don't need to predict the market, and you don't have to be a financial genius. The real secret to building wealth is understanding the random nature of the market and learning to move with it instead of against it. In this audiobook summary video, we'll explore why most hot stock tips only make you poorer and reveal the simple yet powerful strategy that has helped millions of Americans achieve lasting financial freedom. Part 1. The stock market and the game of randomness. When it comes to investing, most people believe they can outsmart the market. You read the news, follow CNBC, buy stocks based on a tip from a stock-savvy friend, and hope to make a quick profit. But Burton Malkiel points out a harsh truth. The stock market is more like a coin toss, far more random than you think. Take 1999, for example. Millions of Americans poured money into tech companies that had never made a single profit, simply because they believed the internet would change the world. And yes, the internet did change the world, but hundreds of those companies went bankrupt within just a few years. Many who thought they had seen the future ended up losing their entire savings. This was a clear reminder of just how random the market can be. Malkiel introduces the concept of the efficient market. In simple terms, it means all available information is instantly reflected in stock prices. If a company reports strong earnings, its stock price reacts almost immediately. So when you sit at home reading the news a day later and think you can get ahead of the market, that's really just an illusion. One famous study in the US even had a monkey throw darts at a financial newspaper to pick stocks. And surprisingly, the monkey's portfolio performed just as well as many professional investors. It sounds funny, but it perfectly illustrates the reality. In the short term, stock price movements are like a random walk, impossible to predict with accuracy. In fact, if you look back through history, from the 2008 housing bubble to the 2020 pandemic, no top expert was able to accurately call the exact moment the market would crash or recover. Yet TV experts show up every day confidently making predictions. And in the end, it's usually everyday investors who lose because they believe they can beat this random game. So what's the lesson here? You don't need to play fortune teller with the market. A smarter approach is to accept that prices will always swing randomly in the short term. Instead of chasing predictions, focus on building a stable long-term strategy, the very thing this book will guide us through in the chapters ahead. Part 2. Financial Bubbles and the Madness of Crowds. If the previous section showed how the stock market moves randomly, this part reveals another dark side, the madness of crowds. History is full of examples. In 17th century Holland, there was the famous tulip mania. People paid fortunes for a single bulb, convinced prices would rise forever. But when the bubble burst, thousands of families were ruined overnight. That might sound like ancient history, but the same script has repeated itself in America. Take the dot-com bubble of 1999-2000. Everyone believed that the internet would turn every company into a billion-dollar giant. Investors threw money at any business with .com in its name, without caring if it was actually profitable. When the bubble popped, the Nasdaq collapsed by over 70% in just a few months, wiping out entire portfolios. Or more recently, the housing bubble of 2008. Buying homes as investments became a national craze. People believed real estate prices would always go up, and banks handed out loans recklessly. The result? When the bubble burst, millions of American families lost their homes and jobs, dragging the entire economy into crisis. What do all these bubbles have in common? Irrational optimism and herd mentality. When neighbors are making money, when the media is hyping it up, when friends are urging you to join in, it's incredibly hard to stay rational. But ironically, that's when the risk is highest. Burton Malkiel emphasizes that the financial markets aren't just numbers on a screen. They're a mirror reflecting human greed and fear. When the crowd is euphoric, prices soar far above their true value. And when fear takes over, prices crash faster than anyone expects. The lesson here isn't to avoid the market altogether, but to recognize this madness and avoid getting swept away by it. As Warren Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful."
Part 3. The Efficient Market and the Everyday Investor. Burton Malkiel introduces a key idea. Financial markets are often more efficient than we think. In the long run, stock prices tend to reflect nearly all available information. You can read the news, watch CNBC, or follow expert advice, but millions of other investors are doing the exact same thing. By the time you act, prices have usually already adjusted. For example, when Apple announces a new iPhone, thousands of analysts, investment funds, and journalists immediately start making forecasts. That information is absorbed into Apple's stock price within seconds, which means trying to make quick profits from news headlines is almost impossible. This leads to a harsh reality. Most individual investors struggle to beat the market over time. Studies show that the majority of actively managed funds, those that hire professionals to pick stocks, end up underperforming the overall market once you factor in management fees. Think of the market as a casino. Individual investors are like casual players at the table, while large funds are the professionals equipped with advanced computers, massive data sets, and entire teams of analysts. What are your chances of consistently beating them? Very slim. Take Tesla, for instance, a familiar story to many Americans. Some lucky investors bought early and became wealthy, but most jumped in only after the hype had already inflated the price and then lost money when the market corrected. Meanwhile, those who steadily held an S&P 500 index fund over the past 10 to 20 years almost certainly enjoyed consistent gains. Malkiel's point is clear. Instead of trying to outsmart the market, individual investors should play a different game, one of passive, long-term, low-cost investing. That's the real foundation for lasting financial freedom for the many, not the quick-win gambles that only reward the lucky few. Part 4. Active investing versus passive investing. In the world of finance, there are two main paths you can take. The first is active investing, where you or professional fund managers try to pick the best stocks and time the market in hopes of outperforming everyone else. The second is passive investing, where you don't try to beat the market at all, but instead own the entire market through low-cost index funds. At first glance, active investing sounds more exciting. It gives you a sense of control, the thrill of making big moves, and the chance to feel like a winner. But the reality is very different. Countless studies in the US have shown that over the long term, the majority of actively managed funds actually underperform simple index funds, especially once you factor in management fees. For example, if you put your money into an S&P 500 index fund with an annual fee of just 0.05%, over 20 years, the savings in fees alone could equal an entirely new investment. In contrast, active funds often charge 1 to 2% per year, and those fees slowly eat away at your returns. A simple everyday analogy is dining out versus cooking at home. Eating at fancy restaurants feels exciting, but over time the costs add up dramatically. Cooking at home might seem plain or even boring, but it keeps your finances stable and healthy. Passive investing works the same way. It may lack the drama, but it delivers reliable, lasting results. Malkiel argues that markets are simply too efficient for most people to consistently win with active strategies. That's why for the vast majority of individual investors, the smarter path is passive. Buy index funds, hold them for the long term, and let time and compounding do the heavy lifting.
Part 5. The Golden Rule of Diversification. If there's one secret to investing that has stood the test of time for centuries, it's diversification. Burton Malkiel calls this the unshakable law of smart investing. Never put all your eggs in one basket. Diversification means not putting all your money into a single stock, a single industry, or even a single country. Instead, you spread your capital across different types of assets, stocks, bonds, real estate, and even international index funds. This way, if one part of your portfolio drops, another part can help balance it out, reducing your overall risk. Imagine you're an American about to retire. If all your savings were tied up in tech stocks, a crash like the dot-com bubble of 2000 could wipe out most of your wealth in just months. But if you had diversified, owning not only tech, but also healthcare, government bonds, and real estate, that same shock wouldn't have devastated your entire portfolio. A simple analogy is American farmers planting multiple crops on the same farm. If corn has a bad season due to weather, soybeans or wheat might still bring in income. Investing works the same way. You plant different seeds so that you'll always have something to harvest. What makes this especially powerful today is index funds. Even an ordinary investor can diversify easily with just a few investments. For example, buying an S&P 500 index fund means you indirectly own 500 of the largest companies in the US, instead of betting everything on just one. Malkiel emphasizes, diversification doesn't eliminate risk, but it shields you from unnecessary risk. It's like wearing a seatbelt while driving. It won't prevent accidents, but it greatly increases your chances of walking away safely. The key takeaway here is simple. Always diversify to protect your wealth rather than making risky all-or-nothing bets. That's the foundation for staying in the game over the long run. Part 6. Life Cycle Investment Strategy. Burton Malkiel emphasizes that investing is not a one-size-fits-all formula. At different stages of life, we have different priorities, needs, and levels of risk tolerance. That's why your investment strategy should evolve with your life cycle. When you're young, you have time on your side. This means that if the market takes a hit, you have plenty of years to recover. At this stage, it makes sense to invest more heavily in stocks, assets that carry more risk, but also offer greater long-term rewards. For example, a 25-year-old just starting a career in the US can confidently put most of their income into stock index funds, knowing they won't need that money until retirement 30 or 40 years later. As you reach middle age and approach retirement, the priority shifts. It's no longer about maximum growth, but about capital preservation. A major market crash at age 60 could wipe out half your savings, and you wouldn't have decades to rebuild. That's why your portfolio should gradually tilt towards safer assets, such as government bonds or fixed income funds. A common rule of thumb for many American families is the 100 minus your age rule. In other words, if you're 30, you might keep 70% of your assets in stocks and 30% in bonds. If you're 60, the balance flips, about 40% in stocks and the rest in bonds. Malkiel also stresses one crucial practice: regularly rebalancing your portfolio. Markets move constantly, and without adjustments, your stock-to-bond ratio can drift far from your plan. Rebalancing is like a routine health check. It keeps your finances aligned with your long-term goals. The life cycle strategy not only helps you maximize growth when you're young, but also protects your wealth as you age. This is the key to building a solid, balanced financial journey over a lifetime.
Part 7. The Financial Habits of the Wise Investor. One of the biggest messages from A Random Walk Down Wall Street is this: financial success doesn't come from finding a secret trick, but from disciplined habits repeated consistently over many years. A wise investor understands they can't predict what the market will do tomorrow, but they can control how they spend, save, and invest every single day. It may sound simple, but that's exactly what makes the biggest difference. Malkiel advises, first, pay yourself first. That means as soon as you earn income, set aside a fixed portion for saving and investing, rather than waiting until the end of the month to see what's left. In the US, people often do this automatically through contributions to retirement accounts like a 401k or IRA. The second habit is to live below your means. Many people who win the lottery or suddenly come into a large sum of money often end up bankrupt within a few years. The problem isn't bad luck, it's the lack of financial discipline. Real wealth isn't about how much you make, but how much you keep and how effectively that money grows. A familiar example is among Uber or Lyft drivers in America. One might earn $60,000 a year, but still struggle because they overspend, while another earns $40,000, saves, and invests wisely, and after 20 years, that second person ends up wealthier. The third habit: don't let emotions drive your investing. When markets rise, greed pushes people to pour in more money. When markets fall, fear drives them to panic sell, locking in losses and missing the recovery. A wise investor does the opposite. They stick to a long-term strategy and rebalance their portfolio when necessary. And finally, Malkiel emphasizes, keep it simple. You don't need to chase after complicated financial products. A basic portfolio of stock index funds, bonds, and an emergency fund is often more than enough to secure your future. These habits may seem small, but together they form the foundation that allows ordinary investors to achieve financial freedom, not through quick wins, but through steady, disciplined choices. Part 8. The final lesson: the random walk to financial freedom. In the end, Burton Malkiel reminds us that the financial markets are at their core a random journey. No one can truly predict whether stock prices will rise or fall tomorrow. The best investors, the most famous experts, even the biggest Wall Street funds, all of them make mistakes often. So what's the real path to financial freedom? The answer lies in patience, discipline, and faith in the long-term power of the market. A well-diversified, low-cost portfolio, built steadily over many years, creates wealth that lasts, far more reliably than any quick trick or hot tip. So in the end, A Random Walk Down Wall Street isn't just a book about stocks. It's a financial roadmap for anyone who wants to live freely without being controlled by money worries. Success doesn't come from luck or genius. It comes from the right habits repeated consistently over time. If you found this summary helpful, make sure to hit like, subscribe, and turn on the notification bell so you won't miss more valuable audiobook summaries. And don't forget to share this video with a friend or loved one, because this might just be the first step on their journey toward financial freedom.